Let's now welcome on the show Mr. Arun Kumar. He's the head of research at fundsindia.com. The topic that we want to discuss with Arun is essentially the data from AMFI. Every month, the Association of Mutual Funds releases very interesting data on which are the categories of funds where investors put in the most money and redeem the most money. Now, interestingly, in equity mutual funds as a category as a whole, investors did put in more money than they redeemed, but the amount, the net investment amount has slowed a little bit. In fact, it's almost halved. What exactly is the reason for that? Is it the second wave? Is it that, again, investors are worried about the kind of havoc that, the second wave and the possible third wave could create, which is why it makes sense to book out money right now? We'll find out in just a short while from now, and we'll also be dissecting which are the most popular fund categories from large cap, mid cap, Flexicap, Arbitrage, or even ELSS. So Arun, thank you so much for joining us today on ET Now. Let's start off with the very first question I posed, that once again in the month of June, we've seen that the net inflows into equity funds as a category as a whole has actually dipped compared to what we saw in May. This despite the fact that markets were extremely strong. We saw markets hit record high levels several times during the month gone by. Is it that investors once again seem to be in one of those profit booking modes where they think that, okay, the market is high, let me quickly take out whatever money I need, because we are once again at the anvil, and the possibility of a third wave, as spoken by many experts, as spoken by many government panels, is looming large.
Thanks, Mubina, for inviting us to the show. So just to, before I address the exact reason in terms of why there's a sudden dip in terms of the inflows, I'll just take a slight bird's eye view and then look at the overall context. Now, if you look at the broad context as to what is happening, we're seeing that there's a lot of money waiting in the sidelines. Now, when you first think about it, it seems very counterintuitive, because we've had a year where there's pandemic, there's a lot of job losses, there's a lot of pay cuts. So naturally, we think that there should be a lot lesser money. But if you really look at the data, look at the current account and savings account data of banks, you've seen that roughly the incremental addition every year, say in FY19 was somewhere sub 5 lakh crores. Again, in FY20 was sub 5 lakh crores. But in FY21, it was twice that. So almost 2 years put together, the additional increment was somewhere close to around 10 lakh crores. This is, even if you split it down to the savings account and current account, it's the same trend that is following. So broadly, the sense that we're getting is that there's a lot of money waiting in the sidelines. Right? So this is what data shows. Now, obviously, it's not that it's spread across the economy. The top segment is obviously had it a lot more easier, and the bottom part of the economy has had a far higher impact. But broadly, with this being the context, if you really look at it, again, the FD returns and your debt fund returns are extremely low. And then again, if you see on one end, equity returns have been really good in the last 1 year. And even if you look at the 3-year, 5-year number, it's somewhere close to the 15% number. So this is a broad context. And again, look at the alternatives. Gold has also been volatile in the last 6 months. So net, it broadly, the trend is that this money which is waiting in the sidelines will eventually get into equities, and at least via mutual funds or the direct stocks, which is what we are seeing. So that's the trend which is kind of started to play out in the last few months, and that's something that is continuing. So in this overall trend in mind, that there is going to be a lot of money coming into the markets, either via direct or either via mutual funds. In this context, what happened to ensure that there is a small dip this time? Because the way we see it is that usually whenever there's a market high, because if you look at the entire last month, Sensex levels were at their market highs, and pretty much they were around those levels. And generally, most of us tend to get a little panicky when markets hit an all-time high, because there's an intuitive feeling that there might be a small correction after that. So that's the reason. And most of the money flows which is coming in is getting staggered. So which means that, let's say if I have let's say 10 lakhs to invest, instead of investing it in one go, I generally stagger it. So the amount will also get staggered because of the all-time highs, and some of them might also want to delay it further, saying that let me wait it out for some more time. So I think these are the two reasons primarily why there's been a sharp dip, or not a sharp dip, but net a small dip in the overall net inflows. But I think the overall trend that the inflows will continue to remain positive and strong over the next few months will continue. So we have to see it in that context, and I wouldn't read too much into what has happened in this particular month. I would attribute it predominantly because of the fact that it's at all-time highs and has not been, it's more or less stayed at all-time highs for the entire last month.
Okay. It's, while of course it has moderated a little bit, but there are certain categories where the investor interest only seems to be continuing. So let's talk about that, Arun, starting with mid-caps. While we speak about all the excitement around markets, there's no denying that it's the mid and the small cap end of the markets that have actually seen the most amount of attention. So do you think that that's something that's continuing to sort of pull equity investors? Are you seeing more retail investor participation? And also, at this point of time, when mid caps and small caps are so strong, do you advise lump sum? Do you advise SIPs if, and investors watching from the outside?
Yeah. So broadly, if you for the question of is there a lot of retail participation coming, it's a definite yes. So if you look at the data, the quarter of, let's say, Jan, Feb, March of this year, when you look at the retail inflows, which is both through mutual funds and through direct stocks, it's the largest in the last 10 years. Right. So there is a definite retail participation which is happening. That's also getting reflected in the. So in fact, a week back, there was a digital brokerage firm which has told that in the last 1 year, out of all the new all the investors that they had onboarded, almost 70% of them are first-time investors. So there's a clear trend, and the data is also showing that there's a lot of retail investors getting into the market. So, and generally the preference is towards mid and small caps because they tend to be a little more aggressive and the return potential is higher. And also given the fact that mid and small caps have had a very long patch of underperformance vis-a-vis large caps. So right from 2018 until March of 2020, they were underperforming. So in the last 1 year, there's been a sharp run-up in both mid and small caps, and the outperformance is also significant vis-a-vis the large cap. If you really look at a 5-year period, the returns are more or less around the 15% level. So the sharp outperformance has come only in the last 1 year. Naturally, if you tend to look at this, it is far more attractive one. And given the fact that there's a lot of retail participation, and the third narrative would also be that usually in an economic recovery, mid and small caps tend to outperform large caps. And broadly, the thesis is that there will be a recovery eventually happening. But we do not know about the third wave, whether it is coming, whether it's there. But broadly, the consensus which is getting built is that we are looking at a strong economic recovery, which is very similar to what we are seeing across the globe. So when you put this all together, this is the reason I think that there's a lot more attention and a lot more interest towards the mid and small cap segment.
Okay. Understood. Arun, that's of course on mid caps. Now, Flexicap funds, it's a relatively newer category. And since the last 2-3 months, we've been seeing investor interest as well. But also, I think the reason why you're seeing that continued inflows in Flexicap funds is also because a lot of NFOs have been introduced. What do you make of this category? It's a new one. I think it's taken the erstwhile place of a multi-cap fund. What's the role it plays in an average retail investor's portfolio?
So usually if you really look at it, earlier multi-cap funds, which was technically what is now called as Flexicap funds. Earlier we did not have a category called Flexicap. So multi-cap funds would essentially have around 70% in large caps. Remaining 30% would be split between mid and small caps. So that's how this whole category was built, and it is flexible to move around. So overall, most investors would look at this as a single product to solve their allocation problems between large cap, mid cap, and small caps. And usually this is used as a part of the core portfolio, which is your main portfolio. And then on top of it, you probably add a sector fund or a mid cap fund or a small cap fund to to improve the return profile of the overall portfolio. But this becomes a very core part of a lot of portfolios. Either conservative investors will probably look at large caps, but most investors who have a 3-year or 5-year experience generally look at multi-caps as a core strategy. But now that multi-cap has a slight varied definition that they are compulsorily supposed to have 25% small cap, 25% mid cap. That mandate is that you can go anywhere and you can do you can move across these segments. So this becomes like a no-brainer category, and a simple category for investors. So once you invest, you don't need to worry too much on is mid cap doing better or small cap doing better, or should I reduce large cap. So all this problem is solved at the fund manager level. Basically, you've outsourced the decision. So I think as a category, it is a very, very important and a basic starting level category for most investors after they're done with large cap. So this is a very important category in that sense. And as you told, there are a lot of NFOs which are getting launched, and hence you might see a slight uptick in terms of the inflows.
Exactly. Now, here's another category, a very interesting one that we are seeing interest come by, arbitrage funds. Massive inflow seen over there. The strategy is very simple and plain cut for an arbitrage fund. When does it work? The markets are close to record high levels, but we do see, the up and down days. When does an arbitrage fund work well, generate good returns for investors?
So the way you look at arbitrage funds is that arbitrage funds are fairly used as an alternative for liquid funds. Now, if you look at the return profile, and if you map the return profile of arbitrage fund over the last 10 years, on a 6-month basis, you will see that the returns will be very, very close to the liquid fund returns. It will be, let's say, plus or minus 0.5%. Right? The advantage of arbitrage, so you might say, hey, it is giving me close to liquid fund return. So And the other second aspect of it is that it's a little more volatile than liquid funds, which is why I'm giving you a time frame of 6 months and not probably 1 month or 2 months, because it's slightly more volatile than liquid funds. Just to give you a sense of context, in the last 10 years, if you look at the daily returns, almost close to 30% of the times there is a slight negative return on arbitrage fund, whereas for a liquid fund category it will be like sub 1%. So you can see the differential in terms of volatility. It won't be like equity, but it will be a minor, small dip that you would see occasionally. So it's a slightly volatile category than liquid funds, but with the same risk return profile over a 6 month. And the question is, why do people invest in arbitrage funds? The main reason is that one, it has a taxation advantage. It is getting taxed like an equity fund, which means that on a 1-year basis, you end up paying a short-term capital gains tax of 15%. Whereas if it is in debt funds, it will get added to your income, and then you will be taxed at your tax slab. So if you are at 30%, then it's a very, very large. The tax component is very large. So, and if you are holding it for more than a year, then you might also end up paying no tax if it is less than 1 lakh as your long-term capital gain. So overall, taxation differential is the key reason why most of them consider arbitrage fund. But the key point to remember is that unlike a liquid fund where the underlying returns are fairly stable and depends on the underlying interest rates, there are 3 or 4 different factors which affect arbitrage fund return. The first factor, there are several factors, but maybe I'll mention the most important 4. Which is one is the overall sentiment on the market. So if it is a bullish market, arbitrage funds tend to do well. And if there is a lot more volatility in the market, arbitrage funds tend to do well, much better than liquid funds in the short run. And the other aspect is also that as a category, it will also reflect the underlying interest rate. So over a 6-month period, you will end up pretty close to the liquid fund returns, again with the tax advantage. The fourth part of this is that what really happens, a very paradoxical thing that happens in the category is that it can't absorb a large size because the arbitrage opportunities are limited. And if the funds do well, then it attracts more money. And because the more money comes in and it goes after the same opportunity, the arbitrage returns start to reduce because you're going by the same arbitrage, because a lot more money is chasing it. the arbitrage spreads start to reduce. So it's a category where you will always see that there's suddenly a large inflow coming because of strong returns. And then again, the moment the large inflows come, the returns dip. And then again, this particular money gets disappointed and takes the money out. So it is a very cyclical category. And if you look at the last 5 years, you will always see trends where when arbitrage funds do well, they attract a lot of money. And this in itself will sow the seed for future underperformance. The moment there is underperformance, the money goes out. And again, there is a lot more arbitrage opportunities, but lesser money. So you are able to comfortably participate. It's a very cyclical category. So I think somebody who's looking at this category, one, should be okay with slightly higher volatility, and they should have a 6-month time frame so that the experience is smoother. But if you're looking at a pure replacement in terms of 1 week, 2 week, or 1 month kind of a return, it may be a lot more volatile. It won't be as stable as a liquid fund. Otherwise, this is a typical pattern which is always repeated over the last 5 years, 10 years, where money comes in and then money goes out.
Understood. Okay, well, there you have it. There's just a brief explainer of some of the most popular mutual fund schemes if we go by the AMFI inflow data for the month of June. Let's take on board some questions and queries then from our viewers. And remember, folks, you can connect with us by writing in on themoneyshow@etnow.tv. Okay, our first question is from BM Shetty. He says, please advise where to invest 25 lakh rupees to get a yield of around 50 lakh rupees in a time span of 4 to 5 years. Well, a tough ask. He's looking at doubling his money in just 4 to 5 years. Well, we would all love that, Arun, of course, but you know, if you want to really get 100% return, and that too in 4 to 5 years, it's not impossible, but it is extremely difficult. And you know, there are very few who get it right, perhaps by some astute stock picking. But what's your advice? I mean, is it unrealistic what Mr. Shetty is asking? Should he perhaps expand his time horizon a little bit?
I think definitely the return expectations seem to be definitely on the higher side. Just to put a context, the 5-year AAA bond yields would somewhere be close to around 6%, right? And usually, all said and done, the equity returns are kind of mapped to your fixed income return. So usually, you end up, if you historically look at a long 100-year kind of a time frame, you usually end up at around 5 to 7% outperformance over a fixed income return. So when you have a few years back, maybe it was at 8-9%, but now the reality is that the fixed income returns are also around 6%. So let's say if you add another 5 to 6% on top of it, roughly around 11 to 12% is the base expectation. Now, obviously, you might get more returns than this if you're starting at a very low valuation. If you're starting at like average valuation, you might end up close to this kind of a return expectation if you have a 5 to 7 year horizon. But if you're starting at a higher valuation, then you need to taper it down a little more. So unfortunately, the valuations right now are not the cheapest and they're slightly above average for sure. At the same time, there's also the opportunity that earnings growth might come out sharply. So for these kind of for 15% returns, obviously you will need the earnings growth to support the entire 15% CAGR over 5 years, which means you will need to be extremely aggressive and a lot of things have to go right. So usually I would say that it's better to temper down the returns given the current scenario. Overall, the way we kind of look at it is we look at all portfolios in terms of 3 buckets. One is the safety bucket. Usually you keep the emergency fund, your insurance, and anything that you need in the short term. Then there's your main bucket or the main portfolio where you do an asset allocation split. So it might be 70% equity, 30% debt, or 50% equity, 50% debt. So this will become your main portfolio. And then there's a third aggressive bucket where you take very, very high risk to have a very high return potential. So if this 25 lakhs is your entire portfolio that you built it, obviously you wouldn't want to risk it out at the aggressive bucket. So I would suggest that it is better to go for a simple asset allocation based on how much ever risk you will be able to take. Risk in the sense like whatever is the temporary declines that you will be mentally okay with handling. And then returns are obviously an outcome that none of us would be able to predict at the here. So one is that. Otherwise, if you're saying that this is something where I already have my portfolio built, this is just I just want to play it out and then try for the maximum return. Then I think equity is obviously a good choice, and within that, maybe you can look at the value category of funds where you have valuation comfort, and most of them are positioned towards the cyclical recovery, and so they are heavily oriented towards the cyclical stocks, but mostly their 5-year returns or 3-year returns will not be on par with other funds because they are positioned for that. That's a place where probably if all these things come right in terms of profit growth and the lower valuations in this, at least the moderate valuations in this segment going up, you might take an attempt at higher returns. Again, it comes with the risk that all of this have to fall in place. If something happens on the inflation front, or globally there's something, there's always a risk around it. But yeah, if it is a part of your aggressive risk-taking portfolio, then you might attempt something like that. But otherwise, I think you have to temper down your expectation and create a simple asset allocation and then let it run.
All right. Okay. Well, with that, we're completely out of time. So, Arun, we let you go on that note. Thanks so much for talking to us on ET Now today.
Thank you.